Hi everyone. This chapter, chapter 6, is a potpourri of everything they didn't know where to put in the other, with the balance sheet or the income statement. And it covers quite a bit, quite a few things. So the two things we're going to concentrate on, though, are interim reporting and the ratios that we calculate from the balance sheet or the income statement. Other things in the chapter that really bear some thought is one, market efficiency and what they mean by market efficiency. The market efficiency kind of blew up in everybody's faces in 2008. They thought that since everything was out in the market, kind of the theory goes, if all of the information is public, then the market or the public and the people using this information will be on equal grounds and make rational decisions. That kind of blew up in 2008, but we still have it and we still try to follow it. What this requires is full disclosure to eliminate insider information so that nobody has one up on the other. And basically that's what all these financial statements are for and all these disclosures are for. GAAP tries to make sure everything that needs to be in the general public for public companies or for companies traded on the stock market are fairly transparent so that they're comparable. So that's what they're talking about with market efficiencies. And some of the items that we have to back up this market efficiency are auditors' reports, and these are usually by independent CPAs. They look at the internal controls. They want to make sure the reports are a fair representation. Like some of the ethical dilemmas we've been talking about, auditors would kind of ferret this out. And if you hear a doggy barking, that's mine. They're trying to figure out if we have reliable financial statements. The next thing up is, even though we have auditors look at the books, it's not the full responsibility of the auditors. It is a full responsibility of management. So you're going to have a report from management in the financial reports, and that's saying they accept the full responsibility of the financial reports. In 2008, we did have some auditors who kind of, I think, look the other way with some companies. Sometimes you can get too close a relationship between the auditors and the management. That has to be watched carefully. I think that was probably evident with Bernie Madoff, and also some of the people or some of the businesses that he did work with. The other thing we're going to look at is segment reporting, and this is where a company will report like segments or like parts of their companies. When you have a very large corporation and it has many segments, you're going to want to have them put those like segments or like products together so that you can see how they're doing overall. And there's some materiality test, and you're going to find that on page 265 that says, you don't have to report everything in one segment, but anything that's material that passes the test for revenue, profit, and assets should be reported as a segment. The type of reporting we look at is interim reporting, and this is pretty much what accountants do. We chunk it up in periods, and instead of reporting for just a year, we're going to do it quarterly. Many times companies do a monthly wrap-up just to kind of keep a handle on what's going on. And these all flow together and tie together. Sometimes you have some issues with periods not matching the operating cycle, okay? And that means a lot of estimates have to be made. And then again, we have to modify and bring those in line at the end of the year for interim reporting. We're actually going to do a couple of companies, their interim reporting. They'll be, I think you'll find them important, and I think you'll find them interesting. The SEC reports basically is a Form 10-K. It's an annual report, and a Form 10-K quarterly. These are reports that the SEC requires. Again, we're looking at market efficiency. Each one of these is supporting this market efficiency and making sure all the information out there is comparable and that it's truly a picture of that company. The final thing that we look at, which is, I always enjoyed this, was percentage analysis, and that's another reason why we do all of these balance sheets and income statements and cash flows and retained earnings and all of the reporting we do for the financials. We do an awful lot of analysis by looking at the totals of each of these accounts. There's a horizontal, let's get up here, horizontal, and there's a vertical, which are basically exactly what they say. If you look at page 277, example 6-3, you'll see an example of a horizontal percentage analysis. Again, vertical is going to be a vertical and looking at relationships back and forth. Page 278, example 6-4, gives you a really good idea of what these are. Finally, we do ratio analysis. And there are, I think, probably about 21 or 22 in the book. I just selected the main ones that you hear most often. You're going to look at stockholders' profitability, and that's going to be your earnings per share, and that basically is net income minus preferred dividends divided by average outstanding shares to give you earnings per share. There is also, when you have a complex corporate structure or capital structure, something called a diluted earnings per share that we're going to learn about in Intermediate 2. You have the profit margin. Everybody's always looking at the profit margin. This is going to be the net income divided by the net sales. You've got the current ratio, which is current assets divided by current liabilities. It's just kind of a very good comparison. There are industry standards that you can then compare to. You've got the turnover debt ratio, which are total liabilities divided by total assets. Very similar, back and forth. We're looking at how fast the debt's being turned over. And finally, the cash flow. And this one's an interesting one. You're going to take the operations per share. So you've got cash flow from operations off the cash flow divided by sales. And this is looked at quite frequently throughout the industry. This is a wrap-up of Chapter 6. I find it really interesting because it is very diverse, and it kind of shows the richness of the financial reports. I think you will enjoy this chapter. We don't really dig into as much of it as we could. I totally expect everybody to take an auditing course because that's a very interesting course to find out how they dig into the records and the financial reports. So I shall see you in the hints. Thanks for listening.